Why don't we get started a couple minutes early? So most of this course is about the theory of how firms behave. And that's what we're going to talk about today. So firms are bundles of individuals, physical assets, and technology that they can use to produce. And we tend to treat these as coherent, profit-maximizing individuals, essentially, in economics. And we don't spend much of the course looking inside the black box of what makes a firm an individual. But because it's so central to the rest of the course, we're going to spend today studying the internal structure of firms. And we'll ask some basic questions, which are good to keep in your mind for the rest of the course. So the first is, what are firms as legal entities? What should and do they maximize? What conflicts arise within firms that prevent them from maximizing the things that they should maximize? How you should govern or finance firms to try to minimize these conflicts? Why do firms exist at all, and why isn't all activity just organized through the market? And we'll talk a little bit about theories of the role of firms and contractual alternatives to firms, and wrap up by discussing how we'll use the term firm during the rest of the course. Okay, so firms come in basically six varieties, though there are lots of variations. The first is called sole proprietorship. And these are small businesses, basically mom and pop stores. Also, if you know most fast food restaurants and other chains are owned under a franchise arrangement where the stores themselves are owned by an individual, but then the name is franchised and some of the techniques are franchised to that local owner, and those tend to be sole proprietorships as well. And what a sole proprietorship is, it's really just an individual doing business on their own account. They pay taxes like an individual. They have the rights and responsibilities of that individual. The second are called partnerships, and these are a group of individuals who get together to form a business, but still have unlimited liability. That is, you can come after and sue or pursue debts on any of the people who are in the partnership. And this is the typical organization for many professional groups, such as lawyers, accountants, sometimes doctors. The third form is a privately held corporation. So we'll talk more about corporations in a minute, but the key difference between a privately held corporation and a publicly held corporation is that a privately held corporation is owned by a small number of individuals, and there's no sort of like liquid market out there for trading the rights to own that company. On the other hand, publicly held corporations trade on public stock markets. There are nonprofit or cooperative firms, which are typically tax exempt and are prohibited in the case of nonprofit firms in dispersing profits to anyone. In the case of cooperative firms, they can disperse profits, but only to individuals who purchase products from them or who work for them. So they can't have external capital suppliers, only the internal workers or consumers of the firm's products. And finally, yeah, what's your name?
My name's Ned.
Yeah.
How do you define corporations that are publicly held, but where the stock market isn't liquid? For example, if the corporation is, owns in over-the-counter shares.
So I think that that's exactly what I was calling a privately held company. Basically, under the United States law, and I don't know about other countries' laws, but under United States law, there's so many burdens that come with being a publicly held corporation that no one would engage in that unless they were going to be able to create the liquid market as a result. So, you have to do all these extra reporting things that go along with being a publicly held corporation, especially after the, what was the legislation called? Sarbanes-Oxley legislation.
Maybe it isn't optimal, but there are examples of it. Usually
Why?
for example, very, very small banks Typically,
They're publicly held?
there are publicly held banks that, or even other companies that they're publicly held. You can buy shares in them without buying huge or engaging in.
I would be very surprised. I would like to see information about that, because like the burden of complying with Sarbanes-Oxley is estimated for a typical corporation to be on the order of like $1 billion a year. So I think I would be very surprised that any company that wasn't at least, you know, several $billion would choose to be publicly traded. But it's possible. Yeah, go ahead.
Your Fed is blocking some of the loans.
Sorry. Well, I don't know what to say. It's life. I'm sorry. Oh, and finally, and this is quite uncommon in the OECD countries. Those are the sort of developed, wealthy countries. But some corporations are owned by the government. Are you still having trouble seeing it? Okay, so we're going to primarily focus on corporations during this lecture and during most of the course. So I want to talk a little bit more in depth about what makes something a corporation. So Edward Lieb, is that you? Lieb? Yeah. So Ned, I guess. What are the defining features of a corporation? Because you seem to know about this stuff, actually.
Well, the defining feature is really the separation of the ownership and legal liability.
Mm-hmm.
But you do have that also in LLCs. I don't know whether you count LLCs as a corporation.
Well, given that the C means corporation, yes. But, oh, is it a company?
Yeah.
I see. Well, partnerships, there's also limited liability partnerships that blur the distinction between partnerships and corporations. So, but yeah, I mean, I would lump pretty much anything which has limited liability and separate personhood as basically a corporation. But anyways, go on with what you're, so what does limited liability mean? Explain that a little bit.
It means that, say you get sued and you own a corporation, if that suit is successful and your corporation has to pay money, but your corporation isn't able to pay money, your creditors are unable to come after your assets, only your corporation's assets.
Yeah. So the corporation is viewed as a person from the perspective of bankruptcy, from the perspective of a number of other things in the law. So whereas other forms of businesses are extensions of the persons who are engaged in them, a corporation is a separate person, basically, from the legal perspective. And another difference is that corporations have to pay the corporation income tax. Non-corporate business forms don't pay an additional corporation income tax. They only pay the taxes that they owe as the relevant individuals. Okay, now there are two primary methods for financing a corporation. Is Matthew Klein here?
Yeah.
Yeah. What are those?
Debt and equity.
Can you explain what those are? Don't look at the slides.
Not too well.
Okay. Does anyone else want to explain what debt and equity are? Yeah, go ahead, Jacob.
They could either raise money by borrowing from banks or some other lender, but the problem with that is they would have to pay back with interest.
Mm-hmm.
Or they could raise equity by putting out shares or something of that nature.
Mm-hmm.
And the problem with that is that it dilutes the shares are already out there, and you often have to pay dividends.
Mm-hmm. Yeah, so that's right, Jacob. So the basic methods are debt, where basically you get money from someone, you promise to pay them back a certain amount in future years. If you don't pay them back that amount, they can come after you legally, and anything, once you've paid them off, you don't owe them anything more. Equity, on the other hand, is when someone gets a share of whatever profits that you make in exchange for the upfront financing they give you. Now, under the US legal system, especially for corporations, there's a lot of tax advantages to debt, because basically you can deduct the interest payments that you make on the debt anything above the principal from your taxes, whereas for equity, you can't deduct the dividend payments that you make or the effective reduction in control by the current owners of the corporation from your taxes. The typical way that people pay back the value of the company to the equity holders is through dividends, and to make sure that they actually have the control to choose what the company does, they have voting rights and they have the right to choose the board of directors that oversees the company. On the other hand, debt holders don't have that sort of direct control. Instead, when the debt contract is issued, there's usually what are called restrictive covenants, which limit what the company is legally allowed to do in order to protect the interests of the debt holders. Whereas the equity controllers have the right to actually choose what the company does, at least in principle. There are some methods of financing of corporations that blur between the two of these. So for example, preferred shares typically don't have voting rights and have a stronger claim in bankruptcy than do other equity shares, and as a result are somewhat more like debt than like equity, but they're somewhere in between. Okay. So shareholders in principle own the company, and the company, they're supposed to be able to tell the company what to do, but in practice, Justin Wu, is Justin here? Yeah. How to, look up, don't look at the slides. What do shareholders actually do to maintain control of the company? How do they exercise their power over the company?
I'm not sure what you mean. I know they have they have liability in the company as well. So if the company takes the wrong direction, then they also pay for it.
But how do they make sure that the company does what's in their best interest? Anyone else? What's your name back there?
Andy.
Andy. Yeah, and go ahead, Andy.
I believe they have some sort of voting rights to important decisions that the company makes.
Yeah, so they have voting rights. That's an important factor. Anyone else have anything else? Go ahead, Connor.
They could incentivize managers.
Well, that's sort of part of their voting rights, right? So I'm just talking about what are the legal controls that they have. Does anyone else have another? What's your name again? Okay.
So they directly choose the board of directors for the company.
That's one thing. Anything else? Anyone? Yeah, go ahead.
I believe if you're sort of a larger institution like a bank, you could sort of initiate litigation against the company and possess their assets, I guess.
Well, there are actually deliberate legal protections that you have where you have the right to sue the company if they don't act in the interests of the shareholders, in particular in the interest of minority shareholders. So if there are large shareholders, they're legally prohibited from having the company take actions that harm and don't serve the interests of the minority shareholders. Also, an important, I think, effective control is that managers' reputation and sort of the way that the philosophy that's instilled into them is service to the shareholders. So I think that's a softer, not really as much a legal protection, but one that has a big effect on the psychology of how managers think. Yeah, sorry, what's your name?
Matthew Solomon.
Okay.
Who decides, or like what organization is deciding if the large shareholders are taking actions that would harm the smaller ones?
A judge, if a suit is brought by the minority shareholders. Yeah. Okay, so there are also protections of creditors, both banks and bondholders, and particularly they can force a company into bankruptcy if they don't think they have enough to pay or if they've defaulted on debt obligations. And with bank loans especially, there tend to be these covenants that restrict the behavior the firm can take on such as how much risk they can take in various ways. Okay, so during most of the course we're going to assume